Jim Rickards is out with another big prediction. He claims a new discovery in the Utah desert will spark a profit opportunity as big as 4,800% this year. In this video, I will investigate these claims from Rickards and reveal the stocks he's pitching so you don't have to pay $5,000 for his newsletter. No paid or proprietary info is given away in this video, and it's all guesswork based on clues in Jim's publicly available sales presentation. There's lots of stocks to uncover, so we're just going to jump into things. All stocks have to do with an executive order from Trump opening up federal lands for mining, something many stock pickers are pitching these days. This is a video presentation, and here's a screenshot with the clues for the first stock. Jim calls them the Pioneer, and this company helps locate minerals in the ground. Since millions of acres are going to be opened up, and companies need to prove minerals are in the ground before they can mine, this company will be in demand, according to Jim. They've been in this niche for 45 years and mapped the Eagle Ford and Bakken shale projects. They also hold 111 patents in mineral discovery technology. This is Geospace Technologies, ticker GEOS. Here's a quick overview of this investment opportunity. Geospace Technologies, founded in 1980 and publicly traded since 1997, is headquartered in Houston, Texas, with operations spanning across the globe. The company operates through three core segments: smart water, energy solutions, and intelligent industrial, each contributing to its diversified portfolio. While historically rooted in the oil and gas industry, Geospace is strategically expanding beyond energy dependence by investing in new technologies and markets, all while maintaining its established strength in the energy sector. In the third quarter of 2025, Geospace Technologies reported revenue of $24.8 million, a slight decline from $25.8 million in the same quarter last year. However, the company achieved a notable turnaround by posting net income of $800,000 compared to a $2,100,000 loss in Q3 2024. The balance sheet remains strong with no debt and $25.6 million in cash, providing financial stability. While the second quarter of 2025 saw deeper losses of $9.8 million, the Q3 results highlight a significant recovery and mark a key step in the company's financial turnaround. Geospace Technologies' smart water segment has become a cornerstone of its diversification strategy, delivering record high performance with year-to-date growth of 32.7%. A key driver has been the strong adoption of its Hydrocon AMI connectors, which are gaining traction in the market. This growth reflects the company's broader shift toward recurring revenue streams and IoT-enabled technologies, reducing reliance on traditional energy markets. Geospace Technologies is advancing through a series of strategic contracts and product innovations that strengthen its market position. The company secured a major Opto-Seas permanent reservoir monitoring contract to provide seabed monitoring off the coast of Rio de Janeiro, covering nearly 500 kilometers and 140 square kilometers. It also introduced the Pioneer, an ultralight land node that achieved a breakthrough $24 million sale of 100,000 units to Dawson Geophysical, marking a significant commercial milestone. In addition, Geospace expanded into the security and defense sector with its heartbeat detector technology, which is designed with recurring subscription models, further supporting the company's push toward diversified long-term revenue streams. Despite progress in certain areas, Geospace Technologies faces several risks and challenges that investors should consider. Overall revenue remains down, even as the smart water segment continues to grow, highlighting the uneven nature of the company's recovery. Both the energy solutions and intelligent industrial segments remain under pressure, with weak demand and contract lulls limiting performance. The company's growth strategy also relies heavily on the successful rollout and adoption of new offerings, creating execution risk. In addition, market reactions to recent earnings suggest that performance expectations remain elevated, while much of the recovery is concentrated in fewer segments, leaving the company exposed to potential volatility. I'm going to reveal the rest of the stocks in 15 seconds, but before I do that, I want to remind you to sign up for my free report on the top 10 stocks to buy and hold forever. This report comes with no gimmicks, no get-rich-quick nonsense, just solid long-term investments you can actually feel confident owning. Click the link in the description to get your copy right now. Here are the clues for the second stock, which he calls the Wildcat. Trump is also opening up the ocean floors for mineral discovery, and Jim's second pick is a play on that. He claims this company has already mapped hundreds of thousands of miles of ocean floor across Africa, Norway, and the Gulf of America. Trump also handed them the keys to survey 4 million square miles of American territorial waters. This is TGS, a Norway company that's a leader in offshore seismic mapping. Here's what to know about this stock. TGS ASA is a global provider of energy data and intelligence, specializing in seismic surveys, acquisition, and imaging, while also expanding into new energy solutions, such as offshore wind, carbon capture and storage, and geothermal. The company employs around 2,000 people and operates dual headquarters in Oslo, Norway, and Houston, Texas. Its shares are listed on the Oslo Børs under the ticker TGS and also trade in the US over-the-counter market as TGSNF and TGSGY. A major strategic milestone came in July 2024 with the completion of its merger with PGS, creating an integrated player that combines a large multi-client library with its own acquisition fleet, positioning TGS as a stronger force in the global energy data market. Following its merger with PGS, TGS has undergone a significant transformation that is already delivering results. By the end of 2024, the company achieved $100 million in synergies, well above its initial $60 million target, while debt refinancing has generated roughly $35 million in annual interest savings. In parallel, the quarterly dividend was raised to 155 cents per share and is expected to continue in 2025, reflecting stronger cash flow capacity. These improvements stem from an expanded data library, greater control of acquisition capacity, and lower financing costs, all of which enhance TGS's potential for cash generation. However, the full benefit of this transformation depends on maintaining high utilization rates across its fleet and achieving consistent monetization of its multi-client library. TGS operates on a dual business model that combines sales from its extensive multi-client data library with contract acquisition services, including both streamer and ocean bottom node operations. Looking ahead to 2025, the company plans to invest between $425 million and $475 million in new multi-client projects, with about 70% of this work to be carried out using its own acquisition capacity. A key measure of success is the sales-to-investment ratio, which stood at roughly 2.2 times at the end of 2024, indicating healthy monetization of prior investments. Still, outcomes remain closely tied to offshore exploration and production cycles, government license rounds, and the level of project pre-funding, all of which can significantly influence near-term performance. TGS is building a foothold in new energy markets, positioning itself for long-term diversification, while its current revenue contribution remains modest. The company's main focus areas include offshore wind measurement through LiDAR campaigns, site characterization contracts, and carbon capture and storage assessment projects, highlighted by its digitalization collaboration with Equinor. Despite these initiatives, the segment generated only about $10 million in revenue in the fourth quarter of 2024, underscoring that new energy solutions are still a small part of the overall business. The strategic optionality is clear, but meaningful growth will depend on successful execution and continued policy support for offshore wind and CCS development. TGS faces several risks in areas that investors should monitor closely. Its performance remains highly exposed to offshore exploration and production cycles, as well as regulatory factors such as license rounds and permitting timelines that directly influence sales. Operational execution is another critical factor, with results depending on maintaining strong fleet utilization, around the 70% target for streamer operations, alongside healthy contract rates and robust multi-client pre-funding. On the integration front, the company must deliver on its $110 to $130 million synergy target by the end of 2025, while preserving financial discipline after recent debt refinancing. Finally, while its new energy initiatives in offshore wind and CCS offer strategic promise, their contribution will only grow if project activity and policy support accelerate, making momentum in these areas a key long-term variable. And here are the clues for the last stock, which Rickards calls the innovator. This is another company that finds minerals, and they are 25% faster than traditional methods, 30% less expensive to execute, and 400% more accurate in identifying deposits. He says this company has a market cap of $54 million, with approximately $46 million in annual revenue, but could reach $2 billion in revenue over the next 12 months, giving it 4,340% gain potential. This is Mind Technology, ticker MIND. Here's what to know about this stock. Mind Technology is now primarily focused on its CMAP brand, which designs and manufactures marine seismic survey equipment used in offshore exploration. The company streamlined its portfolio in August 2023 by selling Klein Marine Systems for approximately $11.5 million, narrowing its operations to a single core business line. To maintain compliance with listing requirements and strengthen its capital structure, Mind also executed a 1-for-10 reverse stock split in October 2023. Following the sale of Klein, Mind Technology is now fully centered on its CMAP business, which produces specialized marine seismic exploration equipment for survey contractors and research organizations. This narrower focus means the company has greater operating leverage, allowing it to benefit significantly during industry upcycles, but also leaving it more vulnerable during downturns when offshore exploration activity slows. In fiscal year 2025, which ended on January 31st, Mind Technology reported operating income of about $6.8 million, with $2.8 million earned in the fourth quarter alone, showing solid momentum to close the year. However, in the first quarter of fiscal 2026, ending April 30th, revenue dropped to roughly $7.9 million, resulting in an operating loss of about $700,000. The key takeaway is that while the company has made progress overall, its results remain highly volatile and can swing sharply depending on the timing of projects. Mine Technology's outlook is closely tied to the health of the offshore cycle. Its performance depends on factors such as offshore exploration and production spending, the timing of license rounds, and multi-client investment cycles. Key catalysts to watch include the securing of large CMAP orders, margins on equipment deliveries, and potential diversification wins beyond core exploration customers. At the same time, risks remain significant, ranging from small cap liquidity challenges and heavy customer concentration to order delays and possible capital structure changes. For investors following Mine Technology, several areas are worth monitoring. On the company side, it's important to track bookings and backlog announcements, the pace and success of product deliveries, and the overall trend in gross margins. Industry indicators are equally critical, including the timing and outcome of offshore license rounds, utilization rates of seismic contractors, and overall seismic vessel activity, all of which directly influence demand for the company's equipment. Finally, the financial structure bears close attention. Any capital structure changes, adjustments to preferred stock terms, or shifts in liquidity could materially affect both risk and flexibility for the business. Before you go, don't forget to grab my free report. The 10 stocks I believe you can buy today and hold forever. It's packed with solid long-term picks you won't hear hyped up anywhere else. Just click the link in the description, enter your email, and I'll send it straight to you.